So today we're going to be talking about index funds. And I have to say I'm a little disappointed in myself because I haven't made this video yet. I did do a video a couple of months ago talking about some Vanguard index funds and I covered some of this stuff. But I have yet to do a video that covers everything you really need to know about index funds. So that is what today's video is going to be. So first of all, who do I recommend index funds to? I think index funds should be part of anyone's portfolio unless you're someone who is super ambitious and you want to do all of your investing yourself and pick individual stocks. So me personally, I have most of my money invested in individual stocks and I have a small amount invested in index funds. So I think that's a good idea for some people who want to have some active management of their account. They want to study stocks and they want to be a more active investor. But for someone who's looking to be a passive investor, someone who doesn't want to worry about looking at stocks and reading earnings reports and things like that, then index funds are the best option out there. So first of all, what is an index fund? Well, an index fund is a mutual fund or ETF, which is an exchange-traded fund that is tracking a specific underlying market. Very simple. Now, an exchange-traded fund is just basically it's like a mutual fund that you're able to buy shares of on a secondary market through the stock exchange. So that is one of the things I like about index funds is that you can buy them as you do a stock. So you don't have to necessarily go out there and open a separate account to open up a index mutual fund if you don't want to. Rather than picking stocks and trying to beat the market, many people invest in the broad market indexes themselves because the truth is most investors out there fail to beat the return of the market. It's a very difficult thing to do. So if you're someone who doesn't want to try to do that, if you're someone who doesn't want to actively pick stocks, then you should be looking at index funds. Unfortunately, most people out there get roped into actively managed mutual funds, and I'm hoping to shed some light on that and maybe give you guys at least a realization that you might be paying for something that is not doing you any good. So most actively managed mutual funds fail to beat the market return. How many do you say? Well, here's the answer right here. So in a 10-year period ending in 2015, 82% of large cap funds failed to beat the S&P 500. Now remember, with an actively managed mutual fund, you're paying a much higher expense ratio than you would pay for an index fund. So you're paying money to pay these active fund managers to make investing decisions on your behalf, while 82% of them failed to beat the market return. So the big question for you guys is, the big thing I want you to think of is, what are you paying for exactly? What are you paying these active fund managers for? So if you're someone who has a mutual fund and that kind of scared you and made you realize, oh wow, I may be in that 82%, I want you to go look into your mutual fund, figure out what your expense ratio is, and see if those fund managers are adding any value by actively managing your money. And if they're failing to beat the S&P 500 market return and you're paying them a higher expense ratio than you would be paying for an index fund, you should seriously reconsider whether or not you should have that mutual fund. Now, if they are in the 18% that are beating the S&P 500, then obviously they are adding some form of value by actively managing and researching stocks and allocating the fund in that way. So what are the perks of an index fund? Well, hopefully you're already seeing the reason why people invest in these, but here are the four main perks and reasons why you yourself probably should look at index funds. Number one is the broad market exposure. As we say, you want to be as diversified as possible, and the more diversified you are, the better. So having broad exposure to markets is the best thing you can do as far as diversity and lowering your risk. So number one is the broad market exposure. Number two is that low expense ratio. So you're not paying for active fund management, you're not paying money managers there, so as a result the expense ratio is much lower. So you want to look at your expense ratio of the mutual fund you have and compare it to a comparable index fund and see how much you could be saving. I know a couple percentage points doesn't sound like a lot, but take that percentage and put it into a compound interest calculator and that will likely change your mind as far as how much money you are throwing away by having a mutual fund that's actively managed, especially if they're not beating the market return. Number three reason that index funds are great is because of a low turnover, and as a result there's lower commission costs. So if you're in a mutual fund that's constantly changing allocations and selling and buying stocks, you're spending a lot of money on transaction and commission costs. And the other thing as well is the fact that you're going to have more tax drag that way because you may be paying short-term capital gains tax on those if they're not being held for more than 1 year. And you also have to consider the fact that anytime you're selling you're getting a capital gain from that, so you're paying taxes as you go, so you do have a higher tax drag a lot of the time with actively managed mutual funds. Number 4 is the fact that this is a passive income model, because when you put your money into an index fund, you may continue to allocate money into that fund as you go, but other than that, everything happens behind the scenes. You know, your dividends are reinvested, and as the index changes, so maybe the S&P 500 changes, the companies listed on the S&P 500 index, the actual index fund will change that around behind the scenes. That's really the only time you're going to see any kind of turnover with an index fund, is when the underlying index itself changes. So index funds replicate the performance of an underlying index. Therefore, there's no research or analysis. Research and analysis is what you're paying these active mutual fund managers for, because they're believing and they're hoping that with their research and analysis, they're able to beat the average market return. And as we said before, 82% are failing to do so. Here are some popular indexes that people may be looking at as far as looking for an index fund. The biggest one, I think, is the S&P 500. This is the 500 leading companies on the U.S. stock market. Then we have the Russell 2000. This is another one people like to invest in, looking to get small cap or growth stock exposure. This is a bunch of small cap companies. Then there's the Wilshire 5000, which gives you exposure to the total U.S. stock market. So as far as diversity goes, that's the best thing you can do as far as U.S. stocks, but you also want to be diversified internationally, so make sure you're looking at international stock market funds as well. Then there's the DJIA, the Dow Jones Industrial Average, also known as the Dow 30. This is 30 large cap companies that many consider to be a list of blue chip companies. So if you're looking to invest in blue chip stocks and you don't want to pick individual stocks, investing in a fund tracking the Dow Jones Industrial Average is probably a pretty good idea for you. Then there's the Nikkei, or the Nikkei. I'm going to be honest, I have no idea how to pronounce this one, but this is the Tokyo Stock Exchange Index if you're looking to have some global investments outside of the US. The NASDAQ tracks the securities on the NASDAQ exchange. The FTSE 100 is the top 100 London Stock Exchange companies. And then the VIX is the implied volatility of the S&P 500. Now, there are many more than this. These are just popular indexes that people follow. But as far as index funds go, there's a wide number of companies you can go through as far as purchasing index funds. I'm going to recommend you guys go through Vanguard. And I just want to state that I am in no way getting any kind of kickback by recommending Vanguard. I just have talked to a lot of people. I've done research myself. And I think that most people would agree that Vanguard has the best funds out there, and I'm going to give you guys a couple reasons. First of all, Vanguard offers over 60 unique index funds, and their expense ratio, so the amount that you're paying for that fund management, is 71% lower than the industry average. You want to obviously have that expense ratio be as low as possible, so you're keeping as much of your money as you can. They also offer bond funds. They offer targeted retirement funds, so those are called their vision funds. So at that point, you could say, oh, I'm planning on retiring in the year 2060, and every 5 years, I believe they reallocate the stock and bond percentage of that fund, so you are more heavily in bonds as you get closer to retirement. So there's those funds. They also have stock funds, international funds, as well as real estate investment trust or REIT funds. So there's a ton of different funds you can invest in through Vanguard, and you guys definitely want to look at some bond funds as well as, diversified stock funds. So for me, I'm going to recommend you guys go through Vanguard, but I do encourage you to, shop around and do your own research. But the fact that they are 71% lower than the industry average, that's a good selling point right there, in my opinion. Okay, so the last thing I want to cover, let's say you want to invest in index funds. You've decided you're going to look at your mutual fund and see whether or not they're beating the market return. And then you decide you want to go ahead and buy index funds. Well, how do you do this? The number one way, and I would say the easiest way, is to buy the index mutual fund through the Vanguard website. The only thing is they typically have a minimum account balance. So I believe from the ones I looked at, a lot of them had a $3,000 minimum balance. So if you were looking to invest less than $3,000 in a fund, you would be unable to do that through the Vanguard website. But there is another way to do this. That is through an ETF, an exchange-traded fund, through a secondary market. So at that point, you would look up the stock symbol, and this is basically an ETF is a mutual fund or an index fund traded like a stock. So you buy individual shares of that index fund. So that's another way you can do that, and the share price of those ranges, but you can invest as little as the minimum price for one share. And then the third way you can do it, which is even better for those of you looking to invest a larger amount of money, is through Admiral shares. And this is something new that Vanguard is offering. This is basically where they have larger accounts with a larger minimum account balance. I believe most of them were $10,000 or more. But these accounts, these Admiral Shares accounts, have an even lower expense ratio than what they offer through their traditional mutual fund index funds. So I would say if you're someone looking to invest over $10,000 in a fund, go through the Admiral Shares. If you're someone who is looking to have all of your investments in one place, I would invest in them through the secondary market, through your stockbroker. However, remember that every time you do reinvest, if you're paying commission through your stockbroker, you're going to pay commission. But when you invest through the website, through the Vanguard website, the mutual fund, you're not going to be paying commission every time you add more to your mutual fund. So do keep that in mind. But anyways, guys, that's pretty much all I got for this video. This is index funds in a nutshell. I hope you guys enjoyed this video. If you have any questions, leave them in the description or the comment section below. I'll be sure to answer them. If you guys enjoyed this video, please drop a like. And if you are new to my channel, please consider subscribing to be notified of any future uploads. And as always, I thank you for taking the time to watch this video.